I think the best advice that I can give any retail investor, any passive investor, somebody's like, okay, I got 50 grand or 100 grand and I want to invest it. I know the operator, but like, what else do I need to know? It's understand debt.
Hello, and thank you for joining us today on the Gentle Art of Crushing It show, where we focus on learning and sharing with our listeners all there is to know about how to create success in our lives. This show stands on the shoulders of giants. Our mission is to empower and inspire our listeners to create the life of their dreams whilst having a blast in the process. Let's celebrate life together. Welcome to the show.
All right. Welcome back to the Gentle Art of Crushing It podcast, Passive Investing Edition. My name's Randy Smith, and I'll be your host today. And I am super excited to have Jamie Gruber on with us today. Jamie and I met Jamie through a mastermind that I'm a part of, was actually on his podcast. He is a podcast host for the Tribe of Millionaires. He is the founder of a mastermind community that feeds into GoBundance that's called Emerge, and spent 21 years in corporate America and then quit his job and moved abroad. So, Jamie, welcome to the show.
Thank you, my friend. Good to be here. Appreciate you having me.
Yeah, no, really glad to have you here as well. Well, let's just kick it off. Can you tell the audience a little bit about yourself and how you found yourself leaving your W-2 after 21 years and traveling abroad? Tell us about that story if you can.
Yeah, sure. Native New Yorker by way of Boston to Michigan. That was my life and corporate path, if you will. And my job as an executive in an insurance company moved me from one to the other. So the final position I had was in Michigan near Ann Arbor, where I was promoted to an executive level position. So big pay, big equity, big bonus, all of the bells and whistles, big organization, the whole nine. And immediately upon getting the job, which was this thing I had grinded and pushed for 6-7 years to get to, I hated it. I got everything I wanted and realized it was nothing of what I wanted. It wasn't the thing that was fulfilling me that I thought it would be. So that began the path of saying, okay, well, if I'm making 300-400 grand a year, wife doesn't work, one kid, another one on the way at that point. What do I do if I don't like this? Like, do I find another job within the company? And that just didn't feel good. Do I go outside and find another job in a different company doing a similar thing? And that felt even worse, like a reset of some sort. But I always had this nag, this draw toward the potential of leaving my day job and doing something on my own. And that's the path I chose. Started with real estate. That grew. I went different ways, which we can get into, from an active owner and then eventually to a general partner in a syndication firm where I'm both on the GP and the LP side. And all of that, along with it, led to me building a brand, first in real estate and then a little bit more globally, which led to the podcast and so on. So a combination of all of those crazy things along my journey led me to a day in February 1st, 2021, where I was driving for 3 days. And on the third day of that drive and a lot of reflection, I made the decision that it was time to quit my job. A month later, I flew home. I flew home and I went into my boss's office 21 days to the day to tell her that I was submitting my resignation. And about a month later was my last day, April 9th, 2021. And I've been out of the job since then.
Are you interested in real estate investing but don't know where to get started or think you don't have the time or money? Are you stuck in your W-2 because the golden handcuffs make it hard to walk away? If this sounds like you, check out impactequity.net and schedule some time to talk with the founder, Randy Smith. Randy went from massive income to leaving his W-2 through passive income, and he can help you do the same. www.impactequity.net.
Wow. So be careful what you wish for, because you might actually get it, right? The big high paying job, corporate job. Gosh, it's crazy. You and I have so many similarities in our story. I did not quit my job. The job quit me ultimately at the end, but I was in that similar role and had to make that decision of, do I just go chase something else, right? Another bag carrying role, because I was a sales guy. Or do I jump in and kind of bet on myself and chase the passion? So maybe talk about that for a little bit if you can. Like what did discussions with you and your wife look like at that point? Was this something that, you got the job and then you woke up one day and you realized you hated it, or was it pretty abrupt? Like what was going on during that time?
There's a 30-day feeling out period with any new job, right? You're the new kid in town. Here I am coming from the big city, Boston, to the center of Michigan. And, again, I had worked really hard. I had taken grunt level jobs. I mean, I shouldn't say grunt level, grunt type jobs at the level I was at just to get in the room to be able to qualify for the job. My company made me dance. Go do this job nobody wants, and then maybe you'll be qualified for
Yeah.
that executive job. And I did, and did well. Okay, well then go do this job that nobody wants, and maybe that'll qualify you. And after a lot of dancing, you finally get the job. Within 30 days, the sheen of it wore off. It's like when your kid, spills the drink in that brand new car, right? It's not a brand new car
Yeah.
anymore. And it
Yeah.
became a payment, like with a car, right? It went from a nice new car to a payment. And it was the same thing. It went from a nice new job to a burden, to an albatross. And so, yeah,
Sure.
my that first year, this was 2017, essentially. I remember my wife at some point in that year, I don't exactly remember when, but she came to me and said, "Hey, look, the job you had before, you were traveling. So when we moved to Michigan, which we knew nothing and nobody in Michigan, the idea was you wouldn't be traveling anymore. And look, you're here, but you're not
Uh-huh.
here. Like you're somewhere else mentally, emotionally. I'd rather you're gone 3-4 days a week physically and then fully involved when you're home. But it's like I can see you, but there's no lights on there." So that was signal one that I already knew that I wasn't loving what I was doing, but maybe I can grit my
Yep.
way through and there's going to be a better day. So her conversation with me started the idea that I got to do something better and different. When I presented her with this idea, and this might be the benefit of having a wife that really came from meager beginnings. She grew up in the Dominican Republic. She's an immigrant at the age of 12. She had a home and running water and all that stuff. It wasn't crazy, but not much.
Yeah.
She came from very, very humble beginnings. So for her, when we played out worst case, if I leave this job and I actually pursue happiness, like for her, the worst case was what, a 2-bed apartment. Okay.
Yeah.
A
Yeah.
job that pays less. Okay. The kids still eat. We still have insurance. We could still take care of ourselves. Okay. She doesn't need much. So
Mhm.
that made it much, much easier to make the leap. And yeah, I mean, that was kind of the initial conversations that I had. She sort of enlightened me to the fact that I was just a completely unpresent, not
Yeah.
in place guy, physically, but not emotionally there. And then when she would talk about my fears over me quitting, she was an amazing anchor in explaining the true downside, which was not living in a box. It was a
Yeah.
downgrade in
Yeah.
lifestyle, but still better than most of the world.
Absolutely. God, yeah, no, it's so powerful to have somebody in your ring kind of fighting for you
Yeah.
and, allowing to take a step or two or five steps backwards in order to move forward. And maybe that moving forward is not financially at all. Maybe that moving forward is just happy and peace and serenity and balance in your life. So, yeah, thank goodness you had a spouse because not everybody is blessed with a spouse that's so understanding that doesn't want to chase the dollars just like a lot of us do. So
I agree,
I'm
but on
curious.
that point, real quick, because
Yeah.
my fear with that statement is somebody hears it and they say, "Yeah, there it is. There's my reason for not being able to pursue my dream." And a little
Okay.
sidebar here: I talk to a lot of
Yep.
people about the possibility of pursuing their goal, whatever it is, quitting their job,
Yep.
living in another country, traveling, whatever it might be. And many times they're talking to me to explore and understand what unique advantage I had in their mind so they can
Yep.
disqualify themselves from the race. So they could say, "Oh,
Yep.
that's it. That's it. Your wife was supportive. Mine's not. Therefore, I can go about living my life in an unfulfilled way because I have an excuse that you didn't." Right? Uh,
Yep. Yep.
some people have sick kids and do this. They quit their job or they live their dream. There's
Yep.
circumstances all over that. Everybody has advantages. Everybody has disadvantages. I think that the
Yep.
key, though, is it's not as if my wife was like, "Hell with it, throw caution to the wind." She wanted to make sure that her family was supported, right? Like that, I want to be clear on
Sure.
that. Like any wife or husband would want to make sure that if the breadwinner's about to throw away the bread, that there's some other bread somewhere that's going to take care and
Sure.
feed the family. So I
Yep.
think the key here is, though, there's a point in time along my journey where my wife could see, call it in my eye, the look, the eye of the tiger, whatever you want to call it, a
Yep.
singular determination to have success in this endeavor. And I don't care who
Yep.
your wife, your husband, your friend, your whatever is. And I saw this when I quit my job. In fact, I was initially insulted by this, but then understood why it happened this way. But when
Yep.
somebody has like that kind of focus, not 95,
Mhm.
97, 98, 99% in, but 100% in on whatever it's going to be, no one denies you. No one denies you. When I quit, I'm a 21-year employee who I know is
Yep.
valued because I just got the largest stock award I ever got, which was based on performance. I had a
Yep.
review that was at an outstanding level, which was, one of the top levels you could get. And I got a
Yep.
$15,000 raise. When I quit, no one tried to keep me. And I wondered, like,
They
ooh,
knew.
something that I don't know about me. Like, but
Yeah.
yeah,
Yeah.
the words I had from everybody was, we could see it. Now, real quick, after I left, one of the big bosses, we're talking easily into the 7 figures per year guys, retired.
Yeah.
And he's called me since to ask me about the path, the journey. How can I help him now? Right?
Interesting.
Because he
Yeah.
knew that I had something that I created that was bigger than me and that I was driving towards. So I just wanted to make that point on the wife thing, because I hate for people to have any excuse, especially that one. Don't put it on your spouse. That's a terrible
Yep.
way to be. Like, I don't want to blame my spouse for my misery. Instead,
Yep.
elevate yourself, which is what I think I did, to a point where nobody can deny that eye. Nobody can deny the look in your eyes. Nobody can deny your determination, no matter how skeptical, no matter how conservative they are, your determination to have the life that you want for you and for your family.
I love it. I love it. The grit, that decide, the fact that you make a decision, you're going to get whatever the result is that you're striving towards, no matter what. Like, nothing's going to stand in the way. I like that too. And I think a lot of people they have this terminal uniqueness where it works for everybody else, but there's this reason, and this reason why it won't work for me.
Yeah.
And it's very different than the person that has all the excuses, but is able to overcome those and then still achieve everything and more than what they set out to achieve. So yeah, thank you for doing that. I certainly would not want to give somebody the out. Albeit, I will say it is important to choose the right partner as well.
100%.
So we'll certainly say that as well. But another podcast potentially. But very good. So you had actually, as I would imagine, you had done very well financially. You had created, a great nest egg for your family. I'm sure you were doing all the investments and retirement accounts that we're encouraged to do in corporate America, like we all do. You probably had a bunch of those conversations where it's really difficult to step away from XYZ income because how am I going to do this? And yet you still make the decision to leave. Now, had you already started investing in real estate, or was this you quit and then it was go figure it out, like jump out of the plane and build the parachute? Or did you start building the parachute early?
I started building the parachute, but it was a combination of the two, to be honest with you. So I had, let's see, 5 units of real estate shortly after I got the big executive job. So I had one accidental landlord single family unit that, at a certain point while I was trying to get the big job and getting frustrated not getting it, I did start to think about what else would I do, and real estate became a thing. So that one property went from albatross that I couldn't sell because it still hadn't rebounded in value from '08 to, oh, wait, that's actually an asset. Let me make it that in my brain and on paper, refinance and all that. Then we went out and bought 2 new duplexes. I took out a loan from my 401k to buy 2 new duplexes and bird them, as they say. So I have these 5 doors, right? After that, I realized, you know what, man, buying 2 properties, 2 tax bills, two closings, all that's such a pain in the ass to get 4 units. What if I bought like 10 at once, or 8 or 12? Like, nothing crazy, but all at once, like an apartment building, which sounded huge at the time. But once you get 5 units, like, well, next step, give me a 10 unit or 12 unit. So I found a 16 unit and I partnered up with people on it. So there were 4 of us that bought it. And those 4, the 4 of us together buying this property, were splitting not only the expense, but the cash flow, everything that was happening in it. So I wasn't making a ton off of it. And at the same time, I had went in as a small partner on a 22 unit where I was the sponsor on the loan. So that's my portfolio. I'm at 42 doors, as you hear people say. But when you really boil it down, it was like 10, 12, right? Like when you look at my split of everything. And none of them are truly cash flowing. Like they are, but I got to beef up reserves. I got to make sure, there's other things coming. So like I have a W-2. I'm not going to take the money out. Okay.
Yep.
So that's why I say I started building the parachute. When I made the leap, I had that stuff. I had my real estate and I was like, you know what? I can continue to build on this. And I also had this business now called Emerge, as you mentioned. And that, again, still wasn't cash flowing. It was new. It was only about 3-4 months old, but there was potential in it. More than that, there was impact in it. So I saw if I could dedicate all of my time to this product, this program that helps people get unstuck, and we were seeing early returns on that. What could I
Yep.
do in a year? What could I possibly do? Then I looked at my real estate and said, what if I needed to, would I draw out of that on a monthly basis that I could support my family with? And the number was about
Okay.
$4,000 a month. I could draw about $4,000 a month without reserving any more money. Like what's in the accounts are in the accounts. Hopefully nothing goes wrong. I could draw about $4,000 out a month. So $4,000 was not enough to cover my monthly expenses. And
Sure.
Emerge was not yet cash flowing as a business to where I could extract money out of it. Everything was going back into it. So when I left, it was, I got a little something over here. I've got some money in savings, of course, too, but it's time to leap, time to make the jump. And let me see what I can build on my way out the door here. So a little bit of a combination.
Okay. So 40 doors, $100 a door, essentially, and an expense of this other business that you were launching. But that was truly, it sounds like the passion project of where you really wanted to put your heart and soul was into that other business that was going to lead to what it is today, ultimately. Okay. So,
Correct.
so you're essentially, you're not making enough in your real estate to cover household expenses. You have maybe a nest egg that you're living on. Was there a certain dollar amount that you were comfortable having in savings, or is there a certain number of months that you could sustain this type of lifestyle? Did you consider those things?
I consider three things, and I would give this advice to anybody that is looking to leap.
Sure.
Like, what's the right time? I think there's three markers, two of which are very specific metrics, and one of which is a little bit more of an internal gut check measure. First, 1 year of savings. I mean expenses, not 1 year of salary. You don't need that. 1 year of expenses, and even in that, I think you can go to true expenses, like eating out a little bit, but not like extravagant expenses, 1 year of expenses saved. And I had that. Two is half of your monthly expenses in cash flow outside of your day job in something other than, whether it's a passive portfolio, a business, an Etsy store, an Amazon store, whatever it might be, but half of your monthly expenses covered by external cash flow outside of your day job. And then third, and this is the soft metric, is a true internal belief, in what you can create. So I always say that to leave a job, I mean, yours was forced upon you, but if you have the option of leaving your job, I would much rather see people with those three conditions in place such that they're not running from something, they're running towards something. So in my estimation, it was like, okay, I got a year of expenses, but I got half of that covered per month without me doing anything. So that extends my timeline. I'm not a math guy, but I'm going to guess that gives me another year, maybe, whatever it gives me. 6 months.
Double it essentially.
Let's double it. So that gives me time. And then that true belief. And again, I had launched and had a product that was making income. I had proof of concept. I had market product testing was done, right? I knew that people would buy this thing. Now it's just, how do I profit from it? Maybe I should have done it the other way around. Like, how do you profit and then build it? But the point is, that thing for me was, well, if I'm spending 50 hours plus here on my day job, and I take that and I put it instead over here on something that's already getting paid for in like my night and weekend hours, what could I do with that? So that's where the true belief came from. I had evidence of that belief. So those three metrics: year saved, half your expenses covered by cash flow outside of your job, and a true belief in what you've created. Those three things in place, I think it's time to leap. And that's when I made the decision to leap.
Love it. Love it. And I mean, those are concrete examples that anybody listening to the audience or listening on the show could take a look at those three areas and see. And I think where I was at a disadvantage is when I got laid off, I knew I had this idea, this passion of passive investing. And I wanted to teach other people how to do that and be able to provide that to a larger audience. But I didn't have any idea how to do that. So I think what I lacked in number three, I probably made up for with, a positive mental attitude, a lot of mindset coaching and training and education that I had, and then some general idea of, what are my core strengths, my superpower as it was, that aligned very well with what ultimately I ended up doing there.
Well,
so thank you so much. I think that's great.
Randy, that's great, because I think there's something in there that's a really good lesson that I learned. And it's to your point, like, you don't know. I mean, there's no loyalty in corporate America. There shouldn't be you to the job, and there certainly isn't the job to you. Businesses are going to make decisions that are best for them, and individuals do the same, which we should.
Absolutely. Yep.
A lot of people have a side hustle in their mind. They have something that they would love to do, this thing on the side. They dream about it. I mean, probably I would venture to say more do than don't in that are in corporate America. They've got something that would be really cool for them to do on the side, but they don't start. And the reason they don't start is because they don't know if it's going to work, or if it doesn't work and they have any notoriety with that thing that they're doing, now they're going to be judged. Like these fears take over. If I had to start after I left my job, boy, that would have put me at a major disadvantage for two reasons. One, there's iterations, there's pivots. I started with buying multifamily, and then later I created a multifamily meetup that went national, and it made no money, but it gave me a lot of face time. It got me some space in the space, right? Like I became an influencer, if you will, in the multifamily space without being a huge multifamily guy at that point. So there I am in that. And that taught me what I like. I like this. I like podcasting and all of that. Right? It brought me there. Had I started that after I left my job, I wouldn't have the ability to test and play and pivot and go here and go there and figure out what I truly like. So that's one disadvantage. The second disadvantage is that I would have forced myself to have to monetize way sooner than I was comfortable doing so. There's a value snowball. I think you probably, you know this. There's a value snowball. Like, say you want to raise capital. As an example, if I educate you for free for 3 months, and then I say, hey, I got this deal. Do you want to invest with me? Let's say you have $500,000 available. You might carve out 25 or 50K, right?
Yeah.
I educate you for 3 years, and I'm there for you for 3 years, and you're getting nothing but value from me, and you built this massive KLT, no like and trust of me. And I say, hey, I got an investment. You might put that whole 500K in. The longer you can go without monetizing whatever it is you're building, the longer you can go, the more of a return that you'll generate when you finally make the ask. So for somebody that's sitting in a job and dreams of, I want to make custom signs and put them on Etsy, just make custom signs and give them away if you can afford to do so. Or sell them for cost. Like, it was $20 for me. Just pay me $20 just for materials. Just, wow, this is so cool. You see what this guy does? He does this, he does this, he does this. Just do that, do that, do that. And whenever you need to, the latest possible time that you need to, ask to monetize, truly ask to monetize at that point. The longer you go, it's like debt snowball. The faster you pay, the more you pay the little debts and then builds up, the same thing. The more you give little value, and it builds, and you're giving more value, more value, more value. The moment you say, okay, hey, I got this thing. Do you want to buy it from me? You're going to have your 100, 200 people that pour in and throw money at you because they know that you come from a place of value. I think it's so important. So, start now.
So how do you know, though? How do you know when that point is? And this is shifting a little bit different than a lot of the calls or a lot of the podcasts that we do here. But I have opened my calendar to anybody and everybody that wants to hop on my calendar. And I do that constantly. My wife and I talk about it daily, that, maybe 5 hours a day I'm online helping people, and it's not a monetization thing at all. And no sight that it even might become a monetization piece down the road. So at what point do you start to get a little more protective of your calendar, or do you try to monetize in some way? Like, when is the right time, do you think? Certainly I understand the idea of the value snowball, but
that's two different questions. Okay. So the first question I heard in there was about, how do you know how to prioritize your calendar? I'll explain that in a moment. But before that, or after that, you asked, and I want to answer this first. It was, how do you know when to monetize? So I think that's two different things. In other words, one answer leads to the other answer. So when to monetize? Look, there's a spectrum on this. When it feels right, when you absolutely have to, the answer is the latest possible time. So when you are, let's play a scenario out. So you are out of your job and you're serving other people through these one-off calls. There's the difference between one-to-one service and nurturing. So I guess here's the question back to you. You have a one-to-one call with somebody, then what?
Then it goes into nurturing at that point.
What does that look like? What does nurturing look like?
It's a newsletter, it's deal flow, it's podcast, it is webinars, all kinds of different things.
Okay. So you're doing that.
Excellent.
So as you build that and build that, right, there's a certain point at which you're going to start to get feedback. Maybe you already are getting it about what you provided, the value you provided, or maybe it's a common question. in there, when you start getting a volume of feedback or questions, I call this like the FAQ of you. When people start
Sure.
asking a specific question of you consistently, or it could be
Yep.
a statement or a comment that they make. Now you know you're at a point where you know what they need and what you can monetize. This isn't to take advantage of them, but it's just starting to become
Sure.
where, okay, there's a lot of people asking me this same question that I'm having to answer over and over and over again. It's obviously valuable to them to know. Now I got to figure out pricing and all of that stuff, but let me create a valuable product for them or a valuable offer for them in order to monetize. So in the
Got it.
space of having a job and building a side hustle, allow yourself to iterate, use that W-2 income for you to fund whatever your side hustle is. But the moment that you absolutely have to monetize. I had to monetize months after I launched Emerge. I had to really think about monetization because I was leaving my job, right? So, but at that
Yep.
point, I felt as though I had delivered enough value to enough people who initially joined Emerge. And now through systems and processes, I can get more people to join Emerge, and I'm going to monetize that
Yep.
product in order for me to exist and serve these people outside of my job. Because if I don't have this income, I got to go back and get a job, and I can't serve these people that need the service that I'm providing. So the latest
Absolutely. Yep.
possible, I think, is the answer. On the second
Okay.
question, go ahead.
Okay.
No,
Oh,
what
no,
were we
I was going to say too, it's that whole analogy of you've got to put the oxygen mask on yourself in order to help those around you, right?
100%.
So at some point, you'll reach a point where you have to monetize. Otherwise, it's keeping you from helping the people around you.
Correct. And again, latest possible. I don't mean it has to be years. It could be 2 months, could be 5 days. Like, it just
Sure.
understand though that whenever it is you ask for it, later will get you more. That's it. Later will get you more.
Okay.
That's the only thing that you have to understand. But it's like, monetize at whatever point it makes sense to monetize. So that's one. Two, the question about how do you prioritize your time? In the beginning, when you're starting out, it's almost like it's like a triangle that inverts, right? So if you have a triangle and you look at it in 3 sections, at the very top, 5% of your time, or maybe zero, is paid. Like, nobody wants to, or you're not in a position yet to accept or know how to accept payment for what you're doing. So almost none of your time will be paid, right? The middle is prospecting. So this is where you're just talking. So this might be 20% of your time is prospecting, the middle of the triangle, right? So this is just, hey, I'm talking to somebody who has an interest in maybe something I'm doing, and yeah, let me just get on the phone and serve them, and let me learn what their needs are, and I can build product out of that. And then the third, the 80% at the very bottom, is going to be philanthropy. It's just going to be what you're doing. Let me get on a call, spend 5 hours a week talking to people, giving advice, nothing expected in return. And those two things can blend. The moment somebody offers to pay you, or the moment somebody, you make the offer to them to be paid, and they do end up paying you, now that's got to invert. Now 50, 60, 70% of your time, turn the triangle over, has to be paid people. So the paid are 0% because you don't have any. As soon as somebody starts paying you, you owe them more of your time. It's your duty and responsibility to give them more of your time. 20%, 30%, 20, 30% of that time has got to be prospecting. So if it's like 50, 60% is paid time, 30% is prospecting, and then tithe 10%. Give 10% away of your time to those people. But it's the moment somebody pays you is when you need to start making that conversion. The moment one person pays you for whatever, invests with you, pays you for a coaching program, whatever it is, pays in your Amazon store, spend time on your paying customers more once you have them.
Love it. And I love the fact that you said the bottom piece on the second pyramid is 10% tithing your time, which I think so many people think like tithing just comes down to dollars. But quite often, your time is more valuable than the dollars that you have. So to tithe the hours, I think, is even more important. So
yes, I completely agree.
Thank you. Yeah. Thank you for saying that, because that's a lot of people don't realize that. I think a lot of people, it's a lot easier to cut a check than it is to dedicate, like myself, I shoot to dedicate 4 hours of just selfless giving of my time with no expectation of return at all on a daily basis. And that actually, I feel like I get more reward out of that than I do almost anything else that I do throughout the week.
Yeah, so, agreed. I love that time. Yeah.
Love it. Okay. So, well, let's do this. This has shifted a little bit. All of the conversations I've had on the podcast up to this point has really been focused around educating or inspiring the new passive investor. And I think your story certainly inspires folks maybe to dig deeper, take a look, at least consider that this passion project that maybe has been on the side that they could pursue more. or maybe there is a way, there's an option, there's somehow that they can bring that into their life. Now, my understanding and my belief and my experience is that since I was able to create passive income, it created options for me, and it created really a freedom from corporate America, or a freedom from the handcuffs of the W-2 that allowed me to bet on myself for the first time in my entire life.
Mhm.
And when I got laid off and I was given this option of, here's another job for 250 grand a year, or chase your dreams, I got to say no to that because I had passive income. So let's, if we can, I'd love to dig into kind of some of the nuts and the bolts, or the blocking and the tackling of what you did to get to that point as well. Because I've got a feeling without that $4,000 a month, without this idea, this dream of this other idea, you might still be stuck in the hamster wheel, right?
100%.
So let's, if we can, dig into some of that. You bought a couple of fourplexes, and then you decided to go bigger. You mentioned that you bought a 16 and a 22 unit, and you mentioned that you were partners. So was that a JV agreement that you did on this first one, or
First
was
two,
that
yeah.
some other
First
type
two
of
were
arrangement?
JV.
First
Yep,
two?
yep. Every deal since then, I'm a GP in a syndication. But yeah, the first two, it was first 4 partners, 25% each. 2 of us bought out the other 2 a year later, so we ended up being 50-50. The other one, I was a small JV, small percentage of a JV for sponsoring the loan, and I had my share of that 22 unit. The 2 duplexes were mine and my wife's.
Okay, perfect. So the JV piece, I think that's a pretty straightforward. Generally, you get a group of folks that come together. Everybody has material involvement in that business. They have to be involved somehow in the day-to-day, whether that be signing on a loan, or actually, chasing the tenants and cleaning the toilets, or whatever that is. Now, you mentioned as you went down that you actually signed on a loan as well. And I've heard a lot of people that are high income W-2 folks that get into the space just by simply signing on loans. So what did that process look like for you? And is it something that you encourage other folks to do if they know the operators?
If they know the operators. Yes, that was a great caveat at the end.
Okay.
The,
Yeah.
the reason this worked for me, a quick story on this property, was a 22 unit that me and my primary partner had under contract a year prior. That deal fell out because it ended up being overpriced based on due diligence. So we walked away. There was a third guy that was going to be a small partner with us on the ground. This was in Cleveland. I was living in Ann Arbor, Michigan. The Cleveland-based partner, it was at the time, he would have been a first-time investor in multifamily. Smart guy, realtor, and we knew him because he ran the Cleveland chapter of our multifamily networking group. He kept in touch with the owner. A year later, the owner came down and went to him to say, hey, I'm willing to sell it for X. So we had already vetted this deal. We had already done due diligence the year before, and we knew that the price should be exactly what he was now asking for back then.
Funny.
And the market was up, right? So he's asking for the price that we wanted a year ago, and the market was up. Cap rates were even lower at this point. So on that deal, my partner didn't want to go in on it. This guy in Cleveland had 2-3 people on the ground that he could partner with. And he said, all I really need, unless you want to be more, is a sponsor, somebody with enough net worth to sign on the loan and say, I'll cover it, personally guarantee it if something goes wrong. That's not something to be taken lightly. Obviously, something goes wrong, it's on me, not them. But at the same time, I knew the guy, I knew the property. And for me, the worst case was, if I have to take this over, I'm getting it at a great price. I'm good. So that was the deal. So yeah, of course, I think it's a great, I was a general partner, but as passive as a GP can be. I didn't really do anything on a day-to-day basis. I would chime in on some of the meeting notes that we would have and think, yeah, I think you do this. Yeah, I agree. I don't agree. But by and large, I never saw the property. I never stepped foot on it. My partner did the due diligence physically, but I personally never went to this property. So never saw it, owned it for a few years. We ended up selling it. And for no money in, I think I walked with like a $70,000 check. So for doing nothing for 2 years, I think it was. So so I think it's a great way to get in the game, to have your name on a property and say, hey, I'm an active investor, and to get experience from, working with the managers, working with partners and all of that stuff, but know the operator big time.
And I love the fact that you had a huge history with this. You knew the asset, you had done your own underwriting. You're actually going to buy this thing a year prior. And then you got to come in and knowing full well that if things went south, you would be able to step in and actually operate it. And I can share that I was looking at that same type of partnership with a couple of other folks. And the challenge that I ran into was the people that needed me to come in and sign on loans were not people that I was interested in partnering with. And the people that I was interested in partnering with, they didn't really need me to come sign on the loan. So that risk return that as an investor that I needed to be able to balance well, did not equate to me actually executing on something like that, just for those reasons. Because just signing on a loan, like, you're on the hook. Like, if that note doesn't get paid that month, the bank is calling you. They're not calling the other person. Like, Jim Rohn talks about a story where he signed on a loan and he didn't realize that they'd be able to continue taking out on this loan. And he says, by that example, I learned exactly what that term meant, that I was stuck on this loan until this thing was completely over. So anyways, thank you for walking through that. I think it's a neat thing to take a look at, is potentially a high net worth individual coming into the space, but be very, very cautious, because you can get burned on something like that very quickly. So fast forward here. I know Emerge has been extremely successful. You've been a podcast host now. Gosh, I saw 339 episodes. Hats off. Just amazing work that you're doing there. Ultimately, I'm not sure if I shared this with you before, but that podcast is ultimately what got my interest in GoBundance probably 3 years ago, years before I ever signed up. So it was that podcast that actually got me interested in it.
That's cool.
But you've seen tremendous success over the last handful of years. And I know today you're more heavily involved as a passive investor. And I'm curious what that looks like. When you look at your full portfolio, is this maybe 5% of your portfolio, or 50%, or 30%, or do you even look at it in those terms? I'm just curious.
I do, and it's more. I snickered because it's more than I want it to be. My path on this, and again, you just kind of go, and you figure things out later. But like you say about that percentage, I'll come up with a percentage here while I'm thinking through it. I don't know the exact percentage of how my multifamily falls into my net worth, but it's more as a passive investor than it was, because I've sold everything active, and for different reasons. The duplexes and single family were in New York. We didn't love the environment in New York. Plus the person on the ground, my dad, that was helping us, he's getting older. He was less able to help. So it was like, you know what, offload those. The 22 unit went full cycle. We sold it. The 16 unit, the partner wanted out. And I was between, do I buy him out or do we sell it? And I said, sell it. So if I had any take backs, that would be the one I would buy him out if I had to do it all over again. But be that as it may, it worked out as it did. So all of my active stuff is gone, and I'm an LP, also a GP on a lot of deals. So I would say, gosh, 80%, 85% of my net worth is as an LP at this point in different deals. It's a good chunk. It's a good chunk. Maybe a little less than that as I think through it, but it's a lot. It's not like 30, 40, 50%. It's over 50%. And that's where my wife and I have talked about, like, it'd be nice to own something of our own again. So we're talking about maybe buying an 8 unit or a 10 unit once this whole mess subsides, hopefully in sometime in 2024. But that's the bulk of it. So I hope that answers your question, but I'm sure you have a tag on to that.
It does. And so you don't hold anything in the stock market at all?
No, zero. The only thing I have outside of it is I'm invested in a couple of consumer products. I'm invested in crypto. I went in at the top on that. And a couple of other small things where I'm more of an LP, but now mostly it's all real estate.
It's all real estate. Okay. Yeah. It's interesting. I just interviewed another guest from our mastermind, and he talked about, holding a percentage of your dollars in real estate. If you take a look at the traditional retail investor, they might have less than 5% of their net worth tied up in these type of investments. Then you look at folks that are much more sophisticated. And as you move up the sophistication ladder, you see a higher and higher percentage of holdings in real estate related activities. So, you and I have both drank the Kool-Aid on this, and I'm very, very heavy in syndications as well. But I believe in it. I think it provides a freedom that that folks just don't get if they're playing in the stock market. So, well, I noticed here we've been talking for almost 40 minutes here, and I like to be respectful of everybody's time. So I do have a few final questions that I like to ask everybody, if you don't mind. So with the audience being a new or newer passive investor, the retail investor that's just getting started in this space, what type of advice would you give, or are there books or podcasts or resources that you would suggest that folks take a look at if they're just getting started in this space?
There are, I'm sure there are, none of them that I honestly follow, but if I'm giving advice, I'm going to skip past the know the operator. That's kind of the easy one. Like, man, it's all about the operator. Bet the operator. That's a given. I think the
Yep.
best advice that I can give any retail investor, any passive investor, somebody's like, okay, I got 50 grand or 100 grand and I want to invest it. I know the operator, but like, what else do I need to know? It's understand debt. Debt is everything. There's going to be so much distress in 2024 that it sounds like they're bad deals, but they're not. They're actually good deals. They're performing. They're 100% occupied. Rents are going exactly as planned. But the operator decided on short-term, high-leverage debt that's going to come due before they're able to operate the property. So they're faced with one of two things. Either they do what they call a call-in, meaning like there's a capital call when something's failing just to kind of keep it from failing, right? Like, oh my God, this property is not going well. Throw more money at it to hopefully make it work. Then there's a call-in, which is, hey, this thing's doing well, but we need another year on the debt. So are people willing to put in more money? They're going to have to do that or give the keys back to the bank. There's other options, but those are the two biggies, right? Those are the two biggies that you're going to come across. When you're investing as a passive investor, the number one question I would ask, two number one questions I would ask, what's the loan to value? What's the term? That's it. Okay. What's the loan to value? What's the term? I believe big in low loan to value. And I say low, I mean 70 or less. So 70% or less loan to value, which means that on a $10 million property, they should raise $3 million or more and have 70% of that 10 million be in debt. That's one. And then two, what's the term? Good conservative operators are going to have at minimum a 5-year fixed term and probably an additional 5 years floating. In other words, they don't have to sell the property for 10 years. The deals we do with they're 15 years. We have 15-year terms between fixed and floating, right? Between, hey, it's fixed for 7 years and then it's going to adjust based on where the market is, prime plus whatever and all that good stuff. And there's a cap increase per year on that additional 7 years. But the idea is we're going through turbulence right now. We can ride through. And let's say it's like, okay, we're through, but let's keep operating. Turbulence happens again in 3 years. We can ride through again. So I think that's a big, big piece is not, is it a good deal or not? Is what is the debt? What are the debt terms? What is the loan to value? And what is loan to value? And what is the, what's the term on the debt? If you answer those two questions first, real estate's a long game. I'm in a deal where I did like hey, they're in and out in 2 years and it's not going well. They're not doing well. Thankfully, it wasn't a ton, but still, I'm probably maybe going to get 80% of my money back on that one. But the longer term deals that can ride through, I'll probably get exactly what I was promised, if not close as far as a return.
Yep. Real estate is very, very forgiving if you have the runway and you've got the time that you can stay in the deal. And as you mentioned, I think a lot of the deals that are going to go south next year had 2 or 3 year fixed rate or floating rate debt. Yep. And they were also on the other side where they had 80% loan to values, 80% plus, right? And some of those folks had preferred equity to bring it up even to 90%. So
if you don't have
those are the ones we're going to see.
Yeah, if you don't have the capital to hold on to that, a good deal, like if you have a good deal but don't have the capital to hold on to it, like don't think the bank's going to, that's the one the bank wants. Like, oh, this is a good deal. I'll take that one back because we know we can get our money back for it, right? Like that's the one the bank's going to take. So yeah, I completely agree. A year's going to be tough.
Yep. And actually one more thing to put on top of that too, it's the operators that are executing their business plan. Yeah. The banks are going to want to work with those folks, even if their DSCRs end up falling below that 1.0. If they're executing and they've proven that they can renovate and increase rents and operate an entity, then I think those are the ones that the banks are going to be wanting to partner with.
Yeah, it's funny too.
Good question or good answer there.
Yeah, the bigger you are too, the bigger the operator, the more the banks almost have to work with you. Like if you've got an operator with a $5 million in debt from a bank, but you got an operator with $400 million in debt with a bank, like the bank is going to need to work with that operator. So the bigger, the better in that respect.
Absolutely. Yeah. Too big to fail. Definitely. All right. Well, let's shift on to a couple of these other ones. If you had, Jamie, $100 grand to invest today, where would you place that $100 grand? And not your business. You can't say your business.
Okay. The whole,
you decide. Okay. You decide what you do with it.
I'd put 50 to 75 into a value add multifamily property. I still think it's the king of all asset classes as far as real estate. And I would take 25 to 50 and I would invest it in my personal development.
Love it. I love it. Well, let's do that then. So let's talk about personal development. Tell us a little bit, if you can, how our guests can find you and learn more about Emerge and everything else that you're doing.
Sure, sure. So Emerge is simple. Go to GoBundanceEmerge.com and you can fill out an application to become a potential member of our community. We are a GoBundance community. I'm partnered with the founders of GoBundance. If you're not familiar, that is the tribe of millionaires. And it's an incredible community where people go to, I guess, get accountability for being the best versions of themselves in business, in their health, in their relationships, in contribution, in adventure, in you name it. And it's what I love about it is it's not a 12-step program. It's not something that you, oh, okay, what is it going to teach me? It's like, how about this? You get to hang out with, in many cases, millionaires every week. So if you could do that 52 times a year, self-driven, absolutely high-minded people, 52 times a year, don't you think your results will be better? If you want six-pack abs,
Absolutely.
you go hang out with people that are working out and have six-pack abs. If you want the kind of success that the people in the GoBundance community want, then go hang out with these kinds of people. And that's what Emerge offers people an opportunity to do.
I love it. I love it. Great explanation as well. So living life big and just becoming the person that you want to become, or that your God would want you to become, whatever that is. I think a great definition. Okay, so kind of tying in line with GoBundance, is there a recent bucket list item you've checked off your list, or one you're hoping to in the near future?
The biggest one was moving abroad. So when I quit my job, it was 2021. And part of the vision I was anchored into was being able to, as I put it, travel 3+ months anywhere I want in the world with my family. And so a year after I left the job, when we realized that we weren't going to be in financial ruin, we decided, let's execute that vision. So a year ago, we checked off the bucket list. This is the big bucket. I have a smaller one, but we checked off the bucket list, the idea of moving abroad. So we moved to where I am right now, the Dominican Republic. We've been living here for a year plus. We'll be here for at least another year and then decide after that. But it's been amazing. It's an incredible, beautiful country. We live right near the beach, which, I mean, I live in a place where a lot of people save up all year to go for 7 days. I get to experience that daily, which is incredible. So that's a biggie. On a smaller scale, last week in Atlanta at an event, I got to play bubble soccer. I wanted to play bubble soccer my whole life, where you get in those big bubbles and run into each other while playing soccer. Oh, so much fun. So Zorb soccer, I think they call it. So I got to do Zorb soccer. That was literally on my bucket list. So I got to cross it off.
Love it. I love it. I saw that. You guys, it looks like you guys had a blast out there. I wish I could have been there. I will be there next year for sure. So absolutely.
Absolutely.
Well, very good. Well, Jamie, thank you so much. I really appreciate you coming on the show. I think the audience probably just learned a ton from you. Certainly your enthusiasm and excitement about what you're doing is surely displayed. So thanks so much for being on the show. I really appreciate it.
Appreciate you, man. Thank you.
Awesome. All right. To the audience, as always, I want to thank you again for joining us today. As always, I encourage you to continue your education journey with passive investing in alternative investments. But more importantly than that, I encourage you to take action. Make a decision to invest in your first passive investment deal. I am so convinced that once you do, you'll be so happy you did and just wish you had done it sooner. So thank you again for being here today, and be sure to join us next Thursday for another great episode. Thank you.
Well, there you have it, ladies and gentlemen, another episode of The Gentle Art of Crushing It. It was an amazing episode. We know we sure learned a lot, and we hope you did as well. We want to take a second and thank you so much for viewing or listening to this episode. And please just know that we only ask for one favor, and that is to make this life magnificent. Thank you, and have a wonderful day.